Greet everybody. So good afternoon, everyone. Welcome. My name is Francesco Petruccione. I'm the director of NITheCS, and welcome.
Sorry, Francesco, I think you're frozen. I'm not sure if it's just me.
Yeah, it looks like it's our internet on this side that is problematic.
No problem.
Yeah. Okay,
Yeah.
you are back, Francesco. Hi.
Okay, sorry. I'm here in the same internet as you, so I'm not sure what happened. Anyway, let me quickly introduce Dr. Kamleshan Pillay. Kamleshan is a postdoc at Stellenbosch University. He did his PhD, completed his PhD last year at WITS in environmental science. And he's been working for a long time also as a consultant in this sector of climate change and climate and finance sector. Yeah, and today he will give us an overview of machine learning application in climate finance. In particular in an African context. So Kamleshan, we are really very grateful that you offered this very interesting mini school, and the large number of participants is an indicator that we got the topic right. Yeah. So thank you so much for your time, and I'm very much looking forward to the lecture. And the participants, the online participants, know the rule. Please make use of the Q&A facility to ask questions. If it's super urgent, Kamleshan might accept to be interrupted. If not, we will collect them towards the end. Yeah. So thank you very much, Kamleshan. Over to you.
Thanks, Prof. Good afternoon, everyone. So as Prof. Petruccione has mentioned, I'm Kamleshan Pillay. I've worked very much as a consultant, and during that time have still kept my feet wet with research. And I think the climate finance space has sort of evolved initially from what it used to be. Initially, when most of us started working in this space, it was very much focused on green climate fund applications or climate fund applications generally. And in the last 5 years, maybe it's really become more dynamic and focused on instrument development, and maybe shifted slightly from public to private finance, and really try to expand the suite of instruments and tools and methods that we can apply to really try and scale up the climate finance flows that we so desperately need. So I'll just go to the next slide. What I hope to do with the mini school is really try and lead up to my first postdoc paper, which is focused on machine learning for the global green bond market. And we'll go into the details of the specific topic a bit later, but really it's trying to formulate a financial regulation tool that is missing in the market and really causes a problem of greenwashing existing in the market. And greenwashing really refers to entities that say that they're doing climate change friendly work or environmental friendly work, but they're really not, and maybe using it for other means, and we'll speak a bit about that later. So today is really the theoretical framework that sets the foundation for the mini school going forward. Next week, we'll talk a little bit about different climate finance instruments and how they're used really to mobilize greater capital flows or penalize brown sectors to try and leverage green finance. The third week, I'm going to provide an overview of the various applications of machine learning and AI to climate finance, and this will go beyond some of the postdoc work that I'm doing. And then last, we'll go into some of the detail of the first postdoc paper, and we'll go through some of the code. Also talk about some of the findings from that climate financial regulation tool. and then just how it's going to be used potentially in the market by certain central banks. The postdoc itself has got 3 different publications attached to it. So this is really the one that's more on the private finance side and more on debt capital markets to try and raise capital for climate. The other 2 are more linked to climate economics and climate policy. The second one is really focused on linked emission trading systems and how we can simulate the market to understand how we could potentially trade emissions between SADC countries to try and alleviate some of the pressure that's being placed on corporate entities to meet climate targets. And then the last one is more on the insurance side and linking flood to some of the parametric insurance products that we have available for. This one is in a disaster risk management context, but it could easily be applied to something at the sectoral level as well. So this is kind of where my expertise lies and what I've been researching. But this is very much a theoretical first lecture, and it's trying to make sure that everyone is on the same page as we go to more complicated and complex topics later on the Mini-school. I'm sure many of you have maybe seen some of these diagrams and figures, but for those on the call today that are not familiar with some of the climate science context, this is some of the underlying information that is really key to why we're having such an issue with, firstly, the scientific component of climate change or the impacts associated with climate change, but then also why there's such a dire need for some of the financing to ramp up as we start to lead into the into the Paris Agreement implementation periods that are really important, the 20-30-year targets, for example. What you'll see on the right-hand side is really the AR6, the IPCC sixth assessment report scenario modeling, which is translates to some degree to the AR5 reports, but this is where we find ourselves. And if you've been following the news, you'll see you probably would have seen news articles related to passing the 1.5 degree target that was initially in the Paris Agreement. And this is important not only from a scientific perspective, but it's really shaping the way that the finance community is starting to see climate change. We see a lot more momentum with regards to pension funds, insurance and insurability issues arising specifically in the European and American markets. We're also starting to see central banks really be concerned about systemic risks around climate change and starting to think about how to penalize the market or try and incentivize green and try and disincentivize certain brown sectors to try and make sure that when there are these tipping points, which I'll point out in the next slide, that they are safeguards in place for the financial system to be able to be buffered slightly from climate risk. I will say that there has been a shift away from pure climate finance, maybe more to climate risk. So there has been a slight change in framing, and I'm happy to elaborate on that a little bit later. I think initially when climate finance was introduced as a topic under the UNFCCC, a lot of focus was placed on raising capital and very much trying to pass on capital flows from developed countries to developing countries. But that has subsequently morphed into and spurred very much by the Paris Agreement that there needs to be equal action taken, the urgency of the situation. And that has also culminated into all financial sector players starting to see a role in climate change, be that on the opportunity side or on the risk side. I point out some of the tipping point issues because this is some of the underlying concern with systemic risk in the financial system, that once these tipping points are passed, we could see massive economic challenges and economic losses. And this is, of course, in addition to some of the geopolitical issues that we're seeing play out at the moment, flagging the tariff issues with the US and some other macroeconomic challenges. Going forward, so this is just some concepts that if any of you are unfamiliar with. Climate finance really tries to focus on two different aspects. That's mitigation financing and adaptation financing. Mitigation and adaptation has been something that's been quite unequal traditionally in the financial space, where most of the focus has been on mitigation, and that's typically been for reasons related to revenue streams and real cash flows, where the commercialization or commodification of mitigation sectors has been easier. So, for example, renewable energy has been a market where there's been greater ability of public sector to incentivize private sector and private sector to generate bankable climate finance projects and flows. Adaptation, there's been less focus on it, but given the increase in natural disasters linked to climate change, there has been more focus on it, at least from the insurance and reinsurance side. We do see more corporate stakeholders now starting to understand how to understand how they need to evaluate their physical climate risk. That's more related to adaptation. But in terms of adaptation investment, there's still a lot of work that needs to be done. And I'll point out some of those differences later when we start moving into the cash flows. To make this more African specific, I've kind of picked up a few of the figures that are outlined in the sixth assessment report. I think there are various different impacts that will be felt in different regions across the continent. But the take-home message is really that it will affect the continent as a whole to some degree in every region. And the ability of the continent to manage those climate risks is lesser than in other regions. And you may have heard of the term adaptive capacity, and that's often the issue when we speak about African countries and African entities, that the ability to avoid dangerous climate change impacts is lesser. And there are some components of that is linked to financial capacity as well. Moving on to some of the definitions of climate finance. This is the UNFCCC definition, and it has expanded initially. But really, it's looking at all sources of climate finance, whether it's private or public sector derived, and support that both finances mitigation and adaptation. As I mentioned, on the slide, initially it was very much seen as a transference scheme between developed to developing countries under the Kyoto Protocol initially, through some of the UNFCCC flexibility mechanisms. But now we have a more holistic view of what climate finance is. And if we go to the institutional landscape, we have typical government cooperation, and that can be through some of the major climate funds that we have, like the Green Climate Fund or the Adaptation Fund. But it's also typically being done through bilateral aid or ODA, official development assistance, where some of the projects may be tagged for environmental or climate initiatives. That's what I think springs to mind when we think about climate finance. But obviously, expanding on that, we have a whole host of players on the private side that are now involved in. We'll talk a little bit in one of the case studies about the green bond market and how this mechanism since the initial issuance in 2007 has started to really deliver the kind of flows that we need. And of course, in the African context, there's a bit of issues with that related to debt burden on African stakeholders and the fact that it is still it isn't in the form maybe that African stakeholders would like. Within private sector, there's also insurance. So the actual providing of insurance products to provide coverage against climate risks, but they're also on their asset side providing investment for green. So it can be undertaken in both ways in the insurance market. We also have carbon markets playing a role, which has been a traditional actor. So some of the voluntary carbon markets that you see, such as the gold standard, for example, passing on climate finance for projects that are delivered in emerging markets and developing countries that are able to yield emission reductions that are paid for by certain entities looking to meet their climate targets. And I can go on and on, but there are many mechanisms that we can talk about later. The landscape report, which is produced by CPI, the Climate Policy Initiative, is an annual report that is often released by it's an NGO. They didn't do it during COVID, but more often than not, they release this landscape report, and it tries to provide an overview of how we are financing climate change and where the gaps are. I will say that there's a lot of that there are certain stakeholders that maybe do not align with the methodologies that are provided on that are underlying the results that we see on the screen. But nonetheless, it is a good indication of whether we are going in the right direction. And I think the one thing that I will point out that is it's a bit of a sore issue, that even though we see that we have raised between 670 and 1.4 trillion US dollars, the requirement of what we need to mobilize in terms of climate finance to meet some of the IPCC and UNFCCC scenarios is still very much very much lower than we require. So still a six-fold increase needed to try and meet those scenarios. I will say that when these quantifications are being done, I think the one thing that isn't really taken into account is that even though climate finance flows are increasing, we still see growth in the brown financing. So things like fossil fuel subsidies continue to increase. We see certain countries continuing to push fossil fuel energies, and trying to restore certain sectors that maybe if left organically would be able to transition to ones that are more resilient under climate change. I want to just move over to the next slide, which really tries to break down how these flows are being disaggregated. I think from an African perspective, I think you'll appreciate that most of our climate finance continues to be mobilized by international sources, and that is primarily through the bilateral agreements that we have with countries, but also the international climate funds. There are certain limitations to why we don't receive more. A lot of them are institutional barriers that really limit the ability of the stakeholder to access those climate finance flows in the scale that we require. Of course, there are certain actors under the emerging markets that have been able to access climate finance more successfully, China being one of them. If you see in the table on your right-hand side, if you look at the global share of climate finance, EMDE is still, which stand for emerging and developing markets, still constitutes 60% of the market, with more advanced economies also benefiting from climate finance. But 42% of the 60 is Chinese, related to the Chinese economy. So still work to do for other regions. And this goes back to my point about, where we see climate finance moving in terms of thematic areas, that there's still less being allocated towards adaptation and more on the mitigation side. Despite most of our NDCs, our nationally determined contributions for climate change, citing that we actually need more adaptation finance rather than mitigation. So this is just to point out some of the variations between countries and the African region in comparison to others. This piece of work was actually under the UNFCCC, and it formed the Southern African climate finance strategy for national governments in the region. And it was the underlying technical analysis that me and a colleague conducted. And I'm sure I can see that the text is quite small, but bear with me, I'll just explain a bit further. We see a wide variation, and this was done, just limited to the SADC countries. We see that there are certain countries that have gained more, that have been more successful in gaining climate finance. As you would expect, South Africa and some of the East African countries have gained more. And this is typically because of higher capacity. There has been a large efforts placed by donors to try and enhance some of the readiness, is the term that's used, of these countries to receive climate finance. You've probably heard in review of articles the term bankable proposals, and that is an area where most African countries lack, and it's one of the limiting factors to why we don't really see as much climate finance being allocated. On your right-hand side, you'll see the variation between bilateral, multilateral development institutions and climate funds themselves. And broken down, we have adaptation, mitigation, and then cross-cutting projects, which can have adaptation and mitigation aligned to climate finance flows. Just moving on to the next page, I just wanted to break this down a bit further. We see mainly that a lot of the climate finance flows have moved towards the follow sector, which is agroforestry and land use. Agroforestry, forestry, and land use, sorry. And that, these sectors are, of course, of primary importance in Africa, given some of the reliance in terms of food security, but then also the countries that have been able to access the climate finance flows, of course, have large areas of forest that need to be protected. Also, we see a lot being passed over for general environmental in general environmental management and policy. So a lot of the donor funds have actually been used to try and create the enabling environment for policy. And even though this has been successful, because most countries have a national adaptation plan, an NDC submission, ideas about what they would like to invest. The truth is that there is still a limitation on real climate finance flows that are allocated for project level flows or project level activities. So in terms of implementation, we still lag behind, with a lot of these projects not being allocated to projects that would be able to enhance the resilience and emission reduction potential within countries. Within the study, what we also tried to do was try and focus not only on what African countries would like to receive in terms of climate finance, but also what we are already doing in terms of climate finance. And this was done strategically because there was a want not to just be seen as a lobbying instrument or lobbying report, but rather try and demonstrate that African countries are already trying to finance climate change from their domestic portfolios, and that should be recognized and also should count in our favor, given that many of the historical emissions, most of the historical emissions are not related to Africa, maybe barring South Africa with 2.7%. So there's a lot of text on this, and I apologize for that. But this was the breakdown of climate finance needs. So typically when we do these climate finance flow reports, we are trying to track all of the climate finance flows that have entered into countries, and then try and evaluate from project portfolios what countries require in terms of climate finance need. So needs relates to almost a costing of what projects would require to become investable or come to fruition. And then we use that to calculate the climate finance gap. So what is the ask to donors or private sector? What is needed to be mobilized? I think you can appreciate that there's a large amount of climate finance needs that have been calculated. I will say that it is not an exact science, and most of the methodologies that I've seen being implemented by countries are quite high level, and sometimes may also be limiting, because a lot of the calculations maybe do not really address the actual implementation costs. So just to bear in mind that that number is probably underestimated, and you can see the wide variation between need and flows if you look at the second point, that only 13.4 billion was realized to the SADC region as a whole, which is very, very small comparatively. We did, within this analysis, also try and look at some of the private finance flows, so just beyond public and what countries are passing on to each other. We did look at the BNF data set, which looks at energy investment into African countries. We also looked at domestic finance spending from investment banks and insurance companies and pension funds to try and understand what they are contributing to climate change internally. And there's a whole host of issues that we face in this context, and really tries to and we've really tried to evaluate this, but unfortunately the tagging or labeling of climate finance within private sector entities is quite limited. The practice is not mainstreamed at all. So trying to get an understanding of exactly what private sector is doing regarding climate change is quite a challenge. And the take-home message is really that we're quite far behind in the estimated gap. If you look at the last point, it just provides a summary of exactly where the gap lies and what's needed until the 2030 scenario. I will go over this maybe briefly, but I mean, I'm sure the slide deck will be made available to everyone after this webinar. But this just provides just a Sankey diagram of exactly where the flows are going towards, from stakeholder to sector. It may be a good time for me to pause here and just maybe reflect on the financial instruments themselves. A lot of the African governments within their engagements within the UNFCCC have cited the need for climate finance to be passed on in grants, which are non-repayable financial transfers. Of course, many countries have pushed back against this, because of course, at the moment, especially given the macroeconomic conditions, there are significant challenges with regards to whether public funds are available as donor aid that can be passed on without any repayment. So most of it, that is the want that it be passed on in grants, but of course, a lot of it is actually passed on in debt. So some of the debt is non-market related, so there's a lot of concessionality attached to them, meaning that they have low interest rates attached to them. The payback period is quite long. Sometimes the interest rate can be something like 1 or 2%. So there's a high degree of concessionality. But of course, within debt, there's also the private side, which is the green bond market. And green bonds typically do not have any kind of preferential coupon rate, so they are market related, which is where some of the contestation really comes from, that we have climate finance being passed on to countries that increase their debt burden and still ultimately leads to countries having to foot the bill for their own climate implementation. So just an aside that there are some issues with how climate finance is being transferred from country to country. Okay, so this is trying to lead into what we'll focus on next week. Maybe just to point out that typically a lot of the climate finance has been transferred within grants and project level debt. But there are a whole host of instruments that could be applied to mobilize climate finance. I see a chat question. I'm this President. Okay, Jan. Thank you for that comment. We will go into detail, but if you feel like you're excluded, Renee will definitely remove you from the presentation. If we move into some of the instruments, we have things like feed-in tariffs, renewable energy. Sean, yeah, please go ahead. I'm not sure if you can unmute yourself, but please go ahead. Or maybe chat. Renee, I'm not sure whether Sean is able to speak.
Yes, Kamleshan, I will organize that. Sorry, just a second. Voila.
Okay.
Here we go.
Oh,
Please.
Sean, you're welcome to provide some comments. Sean, I think you may be.
You just need to unmute yourself if you want to speak. Otherwise, use the Q&A. Yeah. Okay, Kamleshan, I don't know. Maybe we skipped the question.
Okay, Sean, just to let you know that you're welcome to
try again at the end. Yeah.
Yeah, Sean, you're welcome to write it in the chat if you're struggling to unmute. Okay, so some of the instruments that we find are really they can be used on the public and private side, but as I mentioned before, a lot of the focus has been on grants and project level debt. There can be, there's a whole host of instruments that are maybe more applicable to the private sector, things like private equity, balance sheet financing, etc. But, of course, this varies between African country. So within South Africa, for example, there maybe is more participation from private sector stakeholders, and therefore some of these instruments are more mature. But we do see the need for risk management instruments that are starting to come online a bit more. If you consider the Green African the Green Guarantee Fund, the African Green Guarantee Fund, which is an organization that has backing from the Green Climate Fund. These types of instruments are becoming more mainstreamed, and it's really as a catalyst to try and mitigate some of the underlying financial risks within the financial sector, and try and crowd in private sector actors so that the general risk level can be something that can be more manageable. So just to kind of make everyone aware that some of these instruments are growing, even though at the moment they maybe are less focused on the African context. Some of the policy incentives, I will say that one of the frustrating parts maybe about certain African stakeholders that have tried to implement some of these policy initiatives is that to some degree the policy landscape or the policy certainty is what is limiting. So in the South African context, it's well understood that some of the bidding windows for renewable energy, the REAP program, for example, a lot of investor confidence and investor certainty has been the frustration. And that has led to some of these policy incentives and policy instruments not being as mainstreamed or not being as certain in the long term, because it's very much determined by political cycles and election cycles. So just to keep everyone aware, this is really where some of the challenges lie. Some of them are very standard and very well understood. Some of them are things that you would have heard or read in academic literature or in news articles. Some countries, of course, have more have grown more in this way in the last 5 years, and that's led to more mobilized capital flows. The policy landscape is often the starting point, because that's often a signal to the financial sector that there is significant room for mobilizing climate finance, or there's an interest in climate and green. So that's often the starting point. But often, the ability to enforce or enact some of these policies is where maybe more of the challenge lies. So typically at national government level, there's still difficulty in terms of institutional capacity. So that is, human capacity at national government level to make sure that policies are being delivered, and also that policies move beyond simply disclosing a plan or prioritized sector to providing real incentives for the financial community. Often there's maybe a misalignment between private and public sector regarding climate change about what needs to be the priority. Is the priority government trying to implement climate change projects or implement climate activities, or is the role of government trying to incentivize private sector to then take on some of the burden and undertake some of these project initiatives? It's it's an area where there's a lot of contestation, especially in certain sectors that are key, like energy. But that is, an underlying issue, that the role of government maybe is not as clearly defined when it comes to climate. Some of the budget allocations, methodologies regarding tagging, climate allocations being variable depending on the macroeconomic conditions, depending on whether certain countries are able to allocate significant funds owing to competing demands like health and social welfare, of course, other disasters, including COVID. These cause real difficulty in making sure that climate budgets are that are allocated in a way that provides certainty to the market. And then, away from kind of what African countries maybe are faced with internally, to maybe more of what are the issues with other stakeholders. A lot of these large climate finance vehicles are quite challenging, given some of the processes that are required. The Green Climate Fund, for example, requires a nationally designated authority, requires an executing entity, and requires a very detailed track record, with the project being developed in a bankable sense according to their investment criteria. And what this often leads to is large time periods of implementation, and really challenging how regularly climate finance can be accessed, and this really slows down the process of trying to get in large tranches of finance that can really spur development quickly. So just to conclude, I've put down two case studies that try and demonstrate the difference between how climate finance has been mobilized by two public sector entities, but the instrument themselves can maybe be thought of as one being private, one being more public sector focused. Given that we're in the Western Cape Province, I thought I'd speak briefly about the Cape Town Green Bond, and this leads in very much to where we'll be going to next week and the following week. So the Green Bond was issued in 2017 and 2018, and it really was spurred by some of the drought that was experienced in between 2015 and 2018. If you look at the use of proceeds, a lot of the allocations are actually for water, which also suggests that it was driven by the context that we faced. Of course, looking at the winter that we've had last year, of course, it's easy to forget that we had a real catastrophic drought, just 6 or 7 years ago. Just in terms of how a green bond is maybe different from a vanilla bond, green bonds maybe do not have any pricing benefits, even though they may if it's done through things like private placement. But typically the pricing benefit is not different. The major difference is that the use of proceeds is allocated towards green, and that is usually disclosed in something called a green bond framework that is issued before the bond goes to market. And during that process, we have the issuer, who is the entity that's looking to raise capital, and the investor, who is looking to subscribe to the bond or purchase it in exchange for the coupon. The idea that maybe many of you are thinking about while I speak is, why should we do green bonds if we could just do vanilla bonds, if there's no pricing benefit? And the idea that was in the thinking of the developers of the instrument was really that green bonds could access a different set of institutional investors that were more interested in green. So that was the kind of underlying thinking, that as we get more mandates from central governments, that there could be more focus placed on green, and there would be these instruments that would need to be in place to meet the appetite of investors. So just a minor issue, just to flag. The bond itself was very well subscribed, and this also related to the credit rating of the city. And even though there were potential downgrade incidents because of the drought during the drought period of 2015 to 2018, the bond itself was still backed, and it's a really good example of a bond that I would consider to be more adaptation focused than mitigation focused. And then we have a more, I would say, a traditional example. This is the DBSA's climate finance facility that was financed under the Green Climate Fund. And it is a fund that is, of course, got a capital structure from the GCF, and it also has internal funds from the DBSA that are integrated within a pool. And this facility is really looking to mobilize private sector climate finance projects, and the funding internally is trying to incentivize private sector actors where there may be marginal projects that have a market-related capital rate to be involved and attract those suite of investors. Of course, it's quite small if you look at the amounts relative to what is needed, but it is a good example of a development financial institution trying to be involved and really trying to be the conduit for public finance that is used to leverage private. So this is an example that we would call a blended finance vehicle, and it's something that has become more common. It's also a bit more common to see development financial institutions playing this role of an interlocutor, trying to raise capital from public climate finance institutions and then passing it on private. I'm happy to go into a bit more detail when we talk about this next week, but I think for the for this presentation, I'll stop here. And I was hoping that we would just have more of a discussion based on your questions as we move more into some of the detail later on next week.
Yeah, thank you very much, Kamleshan, for the very interesting and informative introduction to this very fascinating topic. At the moment, there is no comment neither in the chat nor in the Q&A, but if people would like to ask a question in person, please just raise your hand and I will give you immediately the right to speak. Or if you prefer to use the Q&A and or the chat, please make use of those. I think our audience is still a little bit shy. Yeah. So you already, Kamleshan, you already gave us a little bit of a preview of what will come next week. Do you want maybe do another preview for next week to make sure that all the participants come again?
Yeah, I'm happy to kind of talk a little bit about exactly what we'll be doing. So this is leading up to the climate finance green bond regulation tool that I'm developing. And this is almost the first step to kind of just provide you with an overview of exactly what climate finance is, where the flows are, really what are the challenges in the African context. But next week we plan to go into the instruments, and that really talks about how pricing occurs, how the different instruments are used together in conjunction with each other, trying to give you an overview of exactly what is being done in the landscape. I see a question.
Excellent. Excellent. So now there is, okay, no. Okay, there are now two questions. Why does SA have no data on the publication on this climate finance system?
Yeah. Okay, so there are some sources of public data that the Department of DFFE, Department of Forestry, Fisheries and Environment has. Of course, some of this data is related primarily to what the ministry receives. So it isn't an exact representation of climate finance in the system as a whole. South Africa has a landscape report that was done by Green Cape, also funded through CPI, the Climate Policy Initiative, that provides an overview of the South African market. A lot of the data in there is derived from government sources, some of the DBSA sources as well in terms of the project portfolio. But there's a whole host of private sector data that's missing from that report. So even though we have data that is available, often that data is, that there are gaps in it. And there's a whole host of reasons why that data is maybe it has its challenges. On the private side, there's a lot of confidentiality issues. So certain stakeholders not wanting to disclose what they fund regarding climate change. And that's really, it could possibly be linked to not wanting to be penalized for not doing green or not doing as much. So very much a marketing and transparency issue. But with things like disclosures starting to become more mainstreamed and starting to be pushed by the Reserve Bank, there is a potential that we will be able to get more data as time goes on, because certain entities will be required to disclose what they fund and how much exactly.
Excellent. And there are now two more questions in the Q&A.
Yeah.
One is by Nkululeko Kwabe, and he asks, how has the recent US import-export tariffs affected the climate finance, and in particular, of course, in an African context? Do you want to answer?
Yeah. It's always a hot topic. Yeah, I know. I feel like I opened the store by mentioning tariffs, but so maybe I can talk. So at the moment, of course, you know, we don't know is the correct answer, and that's given because you know, firstly, the American presidency is still. They've changed their mind several times on exactly the level of tariff and how it's going to be passed on. But at the moment, there seems to be a little bit more certainty that the tariffs will stay in place. Some of the issues that come about with tariffs, so there's really two. The first one is maybe a wider issue that is maybe more related to the American position on donor aid, and that's what we've already started to see regarding US aid not being supported anymore. And a lot of the climate finance initiatives are actually funded through these organizations. So there is a potential that maybe the overall American government strategy may affect climate finance indirectly through the donor agencies. I think you know, I saw this great article that, you know, are the tariff wars going to actually help climate change, because there may be these pricing benefits because of certain consumer goods being more expensive, that maybe the demand will go down and actually consumption will go down, which means that there'll be a benefit in terms of climate change. With tariffs, I think that if other countries, maybe not the US specifically, but if other countries start imposing tariffs linked to carbon, which is what certain actors are already starting to think about, and I'm citing the European Union's carbon border adjustment mechanism, then there is a potential that climate finance could flow more internally, because certain organizations see a vested interest in changing their behavior because of the tariffs that are placed on exports. So there's a lot in my answer, but it is complicated, and there are various aspects that it could affect. I think the US tariffs may be less so, given that our trading relationship is less. But of course, there are strategic sectors like agriculture where, you know, where we may see some effects. So my answer is that I think we'll just have to wait and see what the next few months holds, and if the tariff wars continue.
We can update before the end of the mini school.
Yes.
There's another question about how you can get involved in some of these initiatives, even if only at a volunteering advocacy level.
Yeah, I think there are certain organizations that are doing work on climate finance mobilization in country. A lot of NGOs, especially actually quite a few of them in the Western Cape region, specifically in Cape Town. Maybe a better way of doing this is that I could, in one of the slides for next week, just maybe put up a list of organizations that you can go ahead and contact. I'm also happy to put people in touch with these organizations, because I've worked with a few of them. So that would be my answer there. Last question. Okay,
there's
last
question.
Okay.
So there's a last question in the Q&A by Dumizani, who asks, in terms of risk management, if there are any futures or other derivative instruments that farmers or other players can purchase to mitigate against potential effects of climate change.
Yeah, the weather derivatives market in South Africa is not, it's not as as large as maybe in other countries. We do see parametric insurance products being more available, although a lot of these products are focused at the micro insurance level. So, you know, in the context of smallholder agriculture, a lot of it is passed on, but a lot of it does exist, but it's maybe not at the large commercial entity level. We'll go into it a bit more next week when we start talking about weather derivatives and catastrophe swaps and bonds, etc. So I will talk about it a bit more. I will say that I think our insurers have typically focused on indemnity style insurance, you know, with having, you know, with insurance products having, you know, catastrophe linked line, you know, peril coverage within them, rather than having standalone products that are weather related. Yeah, so it's a growing market, but it's quite slow in some.
Thank you. There's another question, but
yes.
Do you know if there are any acts that are being discussed in Parliament or similar?
Yes, yeah. So actually, I was involved in a project with the Reserve Bank, and a lot of these are actually being developed with the regulators in mind, where there is firstly a focus on corporate disclosures that are linked to the International Sustainability Reporting Board. The acronym escapes me, but I think it's the IISB, but it's the IFRS S1, S2 Sustainability Disclosure Guidelines. And there is a lot of push that listed entities, at least, are starting to report sustainability in general, but S2, the guideline, refers more to climate. So it has the climate reporting component in there. So some of these topics are already being pushed. There are certain, so for example, on the JSE, there are listing guidelines that, you know, allow for these sustainability reports to be disclosed. I will say that the reporting is mainly on the sustainability side broadly, rather than climate change specifically. So that's just something to keep in mind, that you know, that these mechanisms do exist. It hasn't been really pushed by government itself. It's being pushed more by financial regulators, specifically the South African Reserve Bank.
Thank you. Then let's give maybe before we close, Sean again a chance of asking.
Yes. Yeah.
And if you are ready, Sean, you just need to unmute yourself. Okay, maybe Sean has again another technical issue like before. In that case, we will ask him to remember.
Yeah, you're welcome to email
and ask
Sean
it again next week. Yeah. Then Kamleshan, thank you very much for the nice introductory lecture. If you are happy to share your slide, just email them to us, and we will upload them next to the announcement on the NITheCS website. Yeah. And I'm looking forward to part 2, and I hope that I'm pretty sure that everybody will be back next week as well. Yeah. So thank you very much, Kamleshan, and yeah, looking forward to part 2 next week. Yeah, thank you.
Okay, good. Thank you so much.
All the best. Thank you very much. Bye-bye.